Water rights have quietly become the last scarce resource of the American West, and increasingly a national issue. As droughts deepen, populations swell, and farms require more irrigation, the value of a single acre-foot grows like currency. Regulators debate who can use what, when, and at what price, while investors watch from the wings. Cities thirst for reliable supply, farmers hedge with water marketing schemes, and corporations wrestle with risk in their supply chains. In a country founded on abundance, scarcity now shapes policy, markets, and the balance of power from farms to financial markets. This topic touches energy, agriculture, and municipal budgets alike. Water rights describe who may use how much water from rivers, lakes, or aquifers. In the western United States, most rights follow the prior appropriation system: you use it or lose it, a rule born during gold rush era scarcity. Today, the same rights trade like stock options, with producers, municipalities, and environmental groups participating. Drought reduces available supply, pushing prices higher and prompting storage, transfers, or curtailment. When drought deepens, farmers compete with cities and industry for limited volumes. Infrastructure, groundwater rules, and climate change all complicate transfers, creating a web of permits, wells, and contractual obligations. This system blends public policy with private arrangements. History shows scarcity shaped policy long before modern markets. In the arid West, early settlers claimed flow by riparian rights. Then the 19th century saw legal battles over who could use what. The decisive shift came with prior appropriation during droughts, often summarized as first in time, first in right. As cities grew after World War II, states created agencies to manage allocations, storage in reservoirs, and interstate compacts. The 1922 Colorado River Compact divided basin water, a framework that still drives allocations to California, Arizona, Nevada, and beyond, while climate shifts stress the system's assumptions. Public interest groups and farmers alike contest how quickly the system adapts. Markets have begun to treat water as a tradable asset rather than a free natural resource. In the Southwest drought, senior water rights can command multi-million-dollar transfers, and long-term contracts are moving at higher discounts in 10-year horizons, reflecting scarcity. Publicly traded water utilities and infrastructure companies have seen aggressive multiple expansions when drought drags on. The Invesco Water Resources ETF and Utilities Index performances track expectations of higher rates for storage, delivery, and treatment. Banks provide project finance, insurers hedge drought risk, and rating agencies track resilience, as every dollar allocated to water carries a growing premium for reliability. Who benefits and who bears the burden is broader than farmers alone. Water utilities and infrastructure builders gain from long-term reliability and higher tariffs, while municipalities face cost of securing new supplies. Agricultural producers watch input prices rise as irrigation becomes more expensive and leases become common. Beverage giants rely on steady supply chains but face inflationary pressures on water-dependent operations. Private equity and sovereign wealth funds have started bidding on water assets, while retail investors eye water-related ETFs for diversification. Insurance, risk management firms, and technology providers also pivot toward drought resilience. Public utilities, farmers, and funds reshuffle portfolios. Water scarcity becomes a macro geopolitical issue as basins cross state lines and even national borders, forcing interstate cooperation and conflict. Climate change increases evaporation and reduces snowpack, tightening the safety margin for irrigation and power generation. Population growth in Sunbelt cities raises demand, while energy sectors rely on cooling and hydroelectric reliability. The policy response blends environmental, agricultural, and fiscal priorities, shaping subsidies, pricing, and investments in desalination, recycling, and efficiency. Global investors monitor drought indicators and appetite for risk in infrastructure. In times of scarcity, credit conditions, insurance costs, and loan covenants all feel the pressure. Geopolitics and macroeconomics converge on rivers just as they do on oil. Smart money has begun pricing water as infrastructure first and commodities second. Private equity and infrastructure funds sweep up water utilities, storage assets, and distribution networks, betting on regulated returns during drought cycles. Large asset managers partner with municipal operators to finance desalination and reuse plants, while sovereign wealth funds diversify into long-duration water rights and cross-basin leases. Retail investors access the theme through ETFs and focused funds, albeit with liquidity constraints. Banks provide project finance, insurers hedge drought risk, and rating agencies track resilience, as every dollar allocated to water carries a growing premium for reliability. The trend accelerates whenever drought headlines surface. Bear case risks lurk behind every headline. Regulatory overreach or price caps could erode returns on water assets, just as political cycles shift subsidies away from infrastructure. Overpayment in bidding wars could leave buyers trapped if drought eases or if storage gains saturate. Green energy transitions require large water footprints, which may clash with conservation goals. Groundwater depletion can undermine senior rights, revealing fragile collateral in lease financing. Liquidity squeezes could hit ETFs and private funds during market stress. Finally, climate volatility may break historic drought patterns, causing abrupt shifts in expected cash flows and portfolio revaluations. Liquidity dries up when banks tighten lending. Retail investors can approach water scarcity as a diversification lever rather than a hype trend. Start with exposure through diversified water infrastructure funds or utilities ETFs, ensuring liquidity and transparent fees. Pair this with traditional sectors like agtech, water tech, and environmental services that benefit from efficiency gains. Focus on long-time horizons and avoid chasing top tickers after headlines. Use risk controls, position sizing, and a clear exit plan. Learn the basics of water rights, groundwater regulation, and municipal contracts to assess cash flow quality. Finally, monitor drought indicators, policy changes, and rate expectations to recalibrate portfolios. Keep costs predictable and stay skeptical of hype cycles. Looking ahead, the scarcity premium on water assets is likely to persist, but so is uncertainty. Climate trends, population dynamics, and technology will shape where investments yield reliable cash flows. Winners are those who pair risk controls with long horizons, diversify across utilities, infrastructure, and water tech, and stay attuned to regulatory cycles. If droughts intensify, prices may spike then normalize.